When we talk about a company's value, we usually think of a single number on a spreadsheet, but that's just the beginning of the story. Today, we're diving into the hidden forces that can make a company worth way more or way less than it seems. Let's get into it.
So, let me ask you this. You've run the numbers, the models are solid, and a company is worth $100 million. Then someone comes in and pays $150 million for it. That just sounds like a terrible deal, right? So what's going on? What do they know that the rest of us don't?
Well, the answer comes down to these three kind of hidden factors. Think of them as special items that can totally change the final price tag: synergy, control, and complexity. Let's unpack them one by one. First up, synergy. Synergy, it's the ultimate corporate buzzword. You hear it every single time there's a big acquisition. But a lot of the time, it's just a magic number they pull out of a hat to make the deal math work. We're going to do better. We're going to treat it like a real tangible asset that you can actually value. So what is it really? The simplest way to think about it is that 1 + 1 = 3. It's this belief that when you merge two companies, the combined entity will be way more valuable than the two of them were on their own. But where does that extra value actually come from?
Well, it's not just one thing. Synergy really breaks down into two main types. First, you've got operating synergy. This is the easy stuff to see, like cutting costs because you don't need two accounting departments, or using combined muscle to break into new markets. Then there's financial synergy, which is a bit more subtle. It could be tax benefits, or the fact that a bigger, more stable company can borrow money more cheaply.
Okay, but how do you put a number on a buzzword? It's not magic. It's actually a really clear 5-step process. First, you figure out what the target and the acquiring companies are worth separately. Then, you add those two numbers together. Next, and this is the key part, you value the new combined company, but this time you bake in all those cost savings and growth opportunities. The difference between that new, bigger number and the old sum, that is the value of synergy. Okay, enough theory. Let's look at a real-world heavyweight battle to make this concrete. Remember when the consumer goods giant Procter & Gamble bought Gillette? The number one reason they gave for the deal was, you guessed it, synergy.
So analysts went to work. They modeled every possible cost cut, every new growth plan, and they were super optimistic, assuming everything would go perfectly. The number they came up with? $17 billion. A massive, massive number for the value of synergy. But here's the twist.
P&G paid a premium of $25 billion for Gillette. Let that sink in for a second. Even in the absolute best case, most optimistic scenario, the value of synergy wasn't even close to the premium they paid for it. And that really brings us to the most important lesson about synergy. It's a real thing. It has real value. But if you just believe the hype and overpay for the promise of it, well, it's almost impossible to ever make that money back.
All right, let's move on to the second tool in our kit, the value of control. Now, you might have heard of something called a control premium, where an acquirer just automatically slaps an extra 20 or 25% on the stock price. That's a common way to think about it, but it's not what's really happening.
The true value of control really boils down to one simple, powerful idea. I can run this company better than the people running it now. It's the gap between what the company is worth today and what it could be worth if someone else was making the big decisions. So to find this value, you actually have to do two different valuations. First, there's the status quo value. That's the company just as it is, warts and all. Then you calculate the optimal value, what the company could be worth if it had the perfect strategy and perfect management. The difference between those two numbers, that gap, that's the prize. That's the value of control. And of course, if a company is already run perfectly, the value of control is zero. This might sound a little abstract, so let's check out a fantastic real-world case. A Croatian tobacco company called Adis Grupa. What makes them so perfect for this is that they had two different kinds of stock, shares that let you vote and shares that didn't. Now think about what you get with each share. If you own a non-voting share, you're basically just along for the ride. You get a piece of the company as it is right now, the status quo value. But if you own a voting share, well, you get that status quo value plus a piece of the potential improvement, the value of control. And that's exactly why voting shares in poorly run companies can trade for a huge premium. It's the price of being able to fix things. Okay, on to our final tool. And this one's a little weird because it's not about adding value, it's about what subtracts value from a company. I'm talking about the cost of complexity.
Picture this. Two companies. They have the exact same profits, same growth, same everything. But one is a simple business with financials that are super easy to understand. The other is this giant tangled conglomerate with opaque accounting. Which one would you pay more for? The simple one. Every single time. Because complexity creates doubt, and investors hate doubt.
But how in the world do you measure something as fuzzy as complexity? Well, analysts have some clever tricks. One of the simplest, and honestly most effective, just count the number of pages in the company's annual report. Seriously, if it takes a company 500 pages to explain what they did last year, it's probably pretty darn complex.
And this isn't just a fun theory. This isn't just a quirk. The market puts a real, quantifiable price tag on being too complex. The data is clear. There's a penalty for being confusing.
And here's the proof. A regression analysis found that for every extra 100 pages in a company's annual report, its valuation multiple, its price-to-book ratio, drops by 0.3. The takeaway couldn't be clearer. Complexity is not free. The market will punish you for it.
So there you have it. Synergy, control, and complexity. 3 incredibly powerful tools to add to your valuation toolkit to help you see what's really going on beneath the surface of any company.
So let's just recap the big ideas one last time. Synergy is real, but you absolutely have to calculate its value or you risk paying for a fantasy. Control isn't some automatic bonus, it's the reward you earn for being able to make a company better. And finally, never forget that complexity is a real cost that gets subtracted right from a company's bottom line value.
So the next time you see a headline about a big merger and you hear a CEO throwing out around words like synergy, you'll know what's actually going on. You'll know to look past the hype and ask the right question. Okay, but show me the numbers.